The race is on for AI. Everybody's trying to get to the next level. Everybody's trying to get to the next frontier. And every time they get to the next frontier, the last generation AI tokens, the cost starts to decline, about a factor of 10x every year.
January 2025. Goldman Sachs publishes a research note that sends shockwaves through tech markets. Title: AI Investment versus AI Revenue, a Dangerous Imbalance. The findings are brutal. Companies spent $450 billion on AI infrastructure in 2024. Data centers, GPUs, networking equipment, software. But actual AI-generated revenue? Only $78 billion. That's a 5.8 to 1 ratio of investment to revenue. Goldman's analysts call it unsustainable. Compare it to the dot-com bubble when similar investment revenue imbalances preceded the crash. Within 48 hours, tech stocks plummet. NVIDIA drops 11.3%. Microsoft down 7.8%. Meta down 9.2%. The AI bubble warnings just became mainstream, and Jensen Huang knows exactly what that means for the company that's been the biggest beneficiary of AI hype, the investment frenzy that lost touch with reality. Let's break down those numbers. $450 billion in AI infrastructure spending. Who's spending it? Cloud providers? Microsoft spent $50 billion on data centers in 2024. Google spent $48 billion. Amazon AWS spent $52 billion. Together, the big three cloud providers spent $150 billion building AI capacity. Then add Meta at $39 billion, Oracle at $18 billion. Smaller cloud providers, another $40 billion. That's $247 billion just from cloud infrastructure. Then there are enterprises building private AI capabilities, financial services firms, healthcare companies, manufacturers, retailers. They're spending billions building internal AI data centers. Goldman estimates enterprise AI infrastructure spending at $120 billion in 2024. Add AI software spending from companies like Databricks, Snowflake, Scale AI, another $48 billion. Consumer AI hardware like AI PCs and edge devices, $35 billion. The total reaches $450 billion in 1 year. That's more than the entire GDP of Norway, spent on AI infrastructure. Now, the revenue side. $78 billion in AI-generated revenue. That includes OpenAI's $3.7 billion from ChatGPT subscriptions and API access. Anthropic's estimated $900 million. Google's AI products, maybe $8 billion. Microsoft's AI add-ons across Office 365, Azure, and GitHub Copilot, roughly $12 billion. AWS AI services, $7 billion. Then there are smaller AI companies. Midjourney, Jasper, Copy.ai, hundreds of AI startups. Together, they generated about $25 billion. Add AI chip sales that directly enable AI applications, maybe $22 billion more. You get to $78 billion total AI attributable revenue. The math is stark. $450 billion invested, $78 billion returned. That's a 17% return on investment. No industry can sustain that. Investors expect returns. When you invest $450 billion, you need to see revenue growth that justifies that investment. $78 billion doesn't justify it, not even close. That's the imbalance Goldman Sachs highlighted. And Wall Street is starting to ask hard questions. The revenue problem nobody wants to discuss.
We reshaped as a result of that. Now, we had this inkling some time ago. You might have heard that several years ago, we just started to build and operate our own AI supercomputers. We call them DGX clouds.
But the revenue problem is worse than the numbers suggest, because much of that $78 billion isn't new revenue. It's revenue shifted from existing products. Microsoft's Copilot in Office 365 charges $30 per user per month. But some of that revenue would have been regular. Office 365 growth anyway? How much is genuinely new revenue from AI? Hard to say. Microsoft doesn't break it out clearly. Same with Google Workspace AI features, AWS AI services. Much of the AI revenue is repackaged existing cloud services with AI branding. OpenAI is one of few pure-play AI revenue stories. $3.7 billion from ChatGPT and API. That's genuine new revenue created by AI. But OpenAI is burning money. They spent over $5 billion on compute salaries and operations in 2024. That's a $1.3 billion loss. Funded by investors. Not sustainable without massive revenue growth. And growth is slowing. ChatGPT user growth plateaued in the fourth quarter of 2024. Enterprise API revenue is growing, but not fast enough to offset compute cost increases. Anthropic's similar story, $900 million revenue, but spending $1.4 billion, losing $500 million annually. Midjourney generates $200 to $300 million in subscription revenue. Profitable on a small scale, but not the billion-dollar revenue generator investors expected. Most AI startups are burning capital, racing to find product-market fit, hoping revenue grows before funding runs out. The AI revenue is concentrated in a few applications: chatbots, image generation, code completion. These are useful tools, but they're not transforming industries yet. They're not generating the trillions in economic value that AI proponents predicted. The NVIDIA dependence that's terrifying.
And now we've been shipping GB200s a year and a half ago. Right now we're in full-scale manufacturing of GB300. And if Vera Rubin is going to be in time for this year, it must be in production by now.
But the biggest vulnerability is NVIDIA's dependence on AI infrastructure spending. In fiscal 2024, NVIDIA generated $60.9 billion in data center revenue. About $53 billion came from AI accelerators, H100s, A100s. The chips companies buy to build AI training and inference capacity. That's 87% of their total revenue. NVIDIA is essentially a pure-play AI infrastructure company now. Gaming revenue is flat. Professional visualization declining. Automotive growing slowly. Data center AI is the entire growth story. What happens if AI infrastructure spending slows? If companies decide they've built enough capacity? If the revenue doesn't materialize and CFOs cut AI budgets? NVIDIA's revenue collapses. The stock reflects extraordinary growth, priced for AI infrastructure spending to continue growing 50 to 80% annually. But if spending plateaus or declines, the stock is worth 40 to 50% less, maybe more. Jensen Huang addressed this obliquely in the Q3 fiscal 2025 earnings call. Analysts asked about sustainability of AI infrastructure spending. Huang's response was rehearsed. He said AI is a fundamental technology shift. Like the internet, like mobile, infrastructure gets built during technology transitions. The spending is rational. Companies are positioning for the AI native future. Demand will catch up to capacity. But his tone wasn't as confident as usual. He knows the numbers. He sees the Goldman Sachs report. He reads the skeptical investor letters. He understands NVIDIA's stock is priced for perfection. Any sign that AI infrastructure spending is slowing sends the stock into free fall, and the signs are starting to appear. The competitor threat that's intensifying. But soft demand isn't NVIDIA's only problem. Competition is intensifying. AMD's MI300X is gaining traction. OpenAI deployed 100,000 MI300X chips. Other customers are testing AMD alternatives. The MI300X offers 35% lower total cost of ownership compared to H100. When AI budgets face pressure, cost matters more. Customers willing to try alternatives to save money. Then there are custom chips. Google's TPUs, Amazon's Trainium and Inferentia. Microsoft working with AMD on custom Azure chips. The hyperscalers are developing their own AI accelerators. They represent 40% plus of AI chip demand. If they shift to custom silicon, NVIDIA loses massive revenue, and they're increasingly committed to reducing NVIDIA dependency, not eliminating NVIDIA entirely, but reducing the percentage of AI workloads running on NVIDIA hardware from 90+% to maybe 60 to 70%. That's billions in revenue NVIDIA doesn't capture. Chinese competitors are another threat. Huawei's Ascend 910B shipped over 60,000 units in 2024. That's $1.5 to $2 billion in revenue, in a market NVIDIA used to own. Export controls locked NVIDIA out of China. Domestic Chinese alternatives are filling the gap. The technology isn't as advanced as H100, but it's improving rapidly. And China is a huge market. Losing it permanently is catastrophic for NVIDIA's long-term growth. The competitive landscape is shifting from NVIDIA monopoly to NVIDIA dominance in a contested market. Still the leader, but no longer the only option. That changes pricing dynamics. Customers negotiate harder, demand better terms. NVIDIA's extraordinary 70% plus gross margins face pressure. Even small margin declines are significant at NVIDIA's scale. 5 percentage points of margin is $3 to $4 billion in profit. Wall Street cares about margins as much as revenue growth.
The valuation reset, that's inevitable.
Are we going to have an AI bubble?
That's the last question. All right, no. All right, let me just tell you what we see. Okay, so I think it's really important when you look at what's happening around the world and go back to first principles of what's happening in computer science and computing.
January 2025. NVIDIA trades at a price-to-earnings ratio of 55. That's premium valuation, justified only if earnings grow 40 to 50% annually for the next 3 to 5 years. But if AI infrastructure spending slows, earnings growth slows too. Maybe 15 to 20% growth instead of 40 to 50%. That doesn't justify a 55 PE. It justifies maybe 28 to 35 P. That's a 40 to 50% stock price decline just from multiple compression. Not because NVIDIA is failing, because the growth expectations embedded in the stock price are unrealistic. Wall Street analysts are starting to adjust. Morgan Stanley cut NVIDIA price target from $195 to $155 in December 2024. Cited near-term headwinds from AI infrastructure digestion period. JP Morgan reduced target from $180 to $140. The stock that everyone wanted becomes the stock everyone avoids. Classic bubble psychology in reverse. Jensen Huang can't prevent this. He can execute perfectly, deliver great products, win customers, maintain technological leadership. But if the broader AI investment cycle turns, NVIDIA's stock suffers regardless. The company is hostage to the AI bubble narrative. If Wall Street decides it's a bubble, the stock reprices. There's nothing Huang can do except wait it out and hope the company's fundamentals eventually support a valuation recovery. What happens next? The AI bubble debate is reaching critical mass. Major investors questioning the economics, media coverage shifting from hype to skepticism, companies hesitating on new AI infrastructure investments. These are warning signs, not proof of a bubble popping, but indicators that the cycle is maturing. The easy money got made. The next phase is harder. For NVIDIA, the next 12 to 18 months are crucial. If AI infrastructure spending holds up, the bubble warnings were premature. The stock recovers, growth continues. But if spending slows significantly, if companies decide they've built enough capacity, if ROI pressures force budget cuts, NVIDIA faces its first real downturn since the AI boom began. Revenue growth slows or turns negative. Stock reprices sharply. Investors who rode the boom lose significant value. The fundamentals suggest spending will slow, not collapse, but grow more slowly. 15 to 20% annual growth instead of 60 to 80%. That's still good, just not the extraordinary growth that drove NVIDIA's valuation. The stock adjusts to reflect that slower growth. Multiple compresses, Price declines 30 to 40%, then stabilizes at levels that reflect NVIDIA as an excellent company in a growing market, not as a once-in-a-generation winner that defies normal valuation rules. If this opened your eyes to the AI bubble risks facing NVIDIA, share it, because Wall Street doesn't want to talk about this yet. Too many investors are long NVIDIA. Too many firms have positions. Admitting bubble concerns means acknowledging portfolios are at risk, but the evidence is mounting. Investment revenue imbalances, customer hesitation, competitive pressure, valuation extremes. These are classic bubble indicators, not guarantees of a crash, but reasons for caution. Subscribe to see what happens when AI infrastructure spending actually slows, because that's coming. Maybe not this quarter, maybe not next, but within 12 to 18 months, the growth rate's moderate. When that happens, NVIDIA's stock faces a reset. The only question is how severe. A 30% correction to more reasonable valuations? Or a 50 to 60% crash if panic selling takes over? We'll find out. And investors who ignored the warning signs will learn an expensive lesson about bubble psychology and valuation discipline.